baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored. We will not allow a one-time increase in the price level to become an ongoing inflation problem.
That's Fed Chair Jay Powell firing up sentiment on the markets with his dovish comments, saying a rate cut may still be needed, although he is still cautious. Live from Sydney, this is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, we've got Asian stocks rising after Fed Chair Jay Powell's dovish comments at Jackson Hole. Traders also looking ahead to a key US inflation reading, as well as a whole lot of earnings headlined by Nvidia. However, doubts are lingering about how much rates may come down. Robeco's head of fixed income for Asia tells us why things still look uncertain. With China's stock market rally looking shaky as consumers remain hesitant, we're going to get an outlook for the world's second largest economy from S4 Capital founder Martin Sorrell. Also, Indian game developer Nazara's stock has lost almost 20% since the government's online gaming bill passed the lower house. We'll be asking the CEO whether the investor reaction is warranted. Well, let's get straight to our top story. Fed Chair Jerome Powell ending his final Jackson Hole speech with a bang, delivering his strongest signal yet that rate cuts are coming. His dovish comments were met with cheers from markets and jeers from President Trump, who says the easing cycle should have begun a year earlier. Heightened political pressure on the Fed was a central theme at this year's symposium, leading to a tense affair that underscored the challenges ahead for the US Central Bank. Also adding to concerns is Trump's threat to fire Fed Governor Lisa Cook if she refuses to resign over mortgage fraud accusations. Cook's potential removal would give Trump the chance to shape the Fed board in his favour and exert more influence over monetary policy. Meanwhile, other policymakers and economists have been warning against political interference at central banks.
You know, in my IMF days, I have seen close hand what happens when a central bank stops being independent or when its independence is under threat. It becomes dysfunctional, it starts doing things that it shouldn't do, and the next step is disruption, it is instability, if not worse. So I think that it should not be debated.
This is the fifth time in the last 5 years that there has been allegations against a Fed official, and already 4 of them have had to resign. So what I'm concerned about is that there seems to have been a culture that has developed at the Fed that has resulted in these 4 resignations. But I am very worried about preserving Fed independence.
Well, let's get some more insights now on the Fed with Chow, head of fixed income Asia at Robeco. Thanks so much for joining us. I want to get the independence question out of the way straight away. I mean, there will be a new Fed chair next year. We can say that with some certainty. But do you think that's going to result in any meaningful change to monetary policy? Because, of course, Jay Powell was a Trump appointee and he has acted independently.
Well, we hope so. And I think what is also important for the next chairman is that he's seen to be perceived as actually independent, because again, when you have kind of doubts on the central bank's independence, it can actually help us make us misinterpret, decisions that otherwise would actually be clearly the right decision to be made. So I think not only does he have to be seen to be independent, but he has to be seen to be perceived by the market as independent too.
Do you feel that there could be any real risk to Fed independence, or is just the optics and the idea of that enough?
I think that it's a very difficult juncture because we're having, let's say, a very pivotal point in the economy and in a cycle where actually, in terms of the kind of action that we're expecting, isn't an easy one to navigate. So interpretation on either side could be very much something that we have to kind of be concerned with. So as we do that, we have to kind of really decide how that interpretation where things are unsure. For example, this action now that has been taken by Powell shouldn't actually be in debate. It should be very clear that the data so far indicates that a pivot towards looking more at the labour market is more warranted. But the fact that we're actually having to debate that this is the right decision is a concern, I think.
Yeah, well, Jay Powell to date has remained firm to sticking to the data, looking at the data, being independent, and we heard his speech there at Jackson Hole, the market interpreting that as dovish. Did you hear anything from that speech that has changed your view on the path forward for the Fed?
I think he's made it very clear that, I think a cut, by saying that it's restrictive, that the cut should be something very clearly that on the way. How much that is and where the uncertainty comes is actually what happens post that. What happens with the data, we all know that actually a lot of the effects from the tariff changes are actually more likely to kind of come through in the fourth quarter. And then what happens then with both the data, not only on the price changes, but actually also on the impact on investments, etc. So again, this kind of leaves more uncertainty for what happens in the fourth quarter.
Yeah, well, we will get a read this week on PCE, which is, of course, the Fed's preferred inflation gauge. We are expecting to see that tick up to 2.9% on year. Is this the impact of tariffs finally feeding through to the inflation numbers? And if so, do you see that being enduring, or is it just going to be a one hit and done?
I think they're going to have to look through that data point for now, because I do think that we will have to wait a little longer to see how the rest of the impact gets through and how price negotiations happen, right? This is going to not be a one time where price negotiation happens straight away at the onset of a change in tariffs, but that is going to be, and of course, the composition of what is being impacted. So I think, again, we'll have to wait to a little bit longer to actually see how that feeds through.
Yeah, this idea of waiting a bit longer has been a controversial one as well. I mean, we were hearing from Mohamed Al-Arian a moment ago on Fed independence, but he had other observations as well in terms of the Fed. Sure, it's been data dependent, but it's not been forward-looking enough. Do you feel that's a fair criticism?
I think it's very hard to be forward-looking when policy and changes are actually happening, with its impact not clearly, visible. So I think a wait-and-see policy is probably the best way that a central bank should react under circumstances where the data is either backward-looking, which is what kind of happened last time when we had the issues with the pandemic, or that the data itself, is ultimately changing its composition, because, say, tariffs is going to change, supply-demand dynamics as well as pricing. So these do warrant a more cautious outlook and a more cautious stance to actually how we move.
It's ironic, really, because had it not been for the tariffs, we might be in a more predictable rates environment. But we have another situation as well where it's difficult to forecast inflation. You're advocating that wait-and-see approach. But in the meantime, we've seen some interesting changes in the employment data. What do you feel is the more urgent concern for the Fed now? Is it inflation or is it jobs?
I do think it's jobs for now, because I think the inflation data does need a bit more time to give them a clearer indication. And I think the other reason for waiting that could actually be very beneficial is actually giving the Fed some sort of credibility, because again, if he is seen to be kind of moving under pressure, that isn't going to be actually good for the view on that the Fed is actually acting in a fashion that is going to lead to stability. So I do think that this is the right manner for a central bank to act.
Well, the consensus is that we'll get lower rates in the US. It is a question of when. How is that informing your approach to fixed income at the moment? What sort of regions, what sort of duration are you looking at?
Yeah. So I think, again, at this moment, the short end is actually a little bit more easy to kind of call, because I think in terms of rate movement, the longer end of the curve, particularly in the US, is a bit more difficult to say, because the inflationary impact is a little bit more uncertain. Even the growth trajectory could be seen as more uncertain, as well as the fact is that we have to accept that with these uncertainty, higher term premium would be implied within the curve. So we're preferring steepening at this point, but probably steepening more at the kind of intermediate maturities, kind of like 5s, 30s, as opposed to kind of like 2s, 10s, where that short-term rates were actually already pricing in fully what the cuts that we're expecting.
And how about your expectation around the US dollar? We've seen a slow grind lower. Do you feel the floor is in yet?
No, I don't. I think that there is still room for the dollar to stay soft. Whether it does it in one fell swoop, and we've had a lot of that softness happen. But I think, given both, as you say, the trajectory of rates, but also the fact that the economic impact of the tariffs that we're fearing is actually not as been as horrendous as we had kind of feared in April, does mean that actually it does leave scope for other economies to do a bit better than the US.
Mm-hmm. So let's look ahead to the next Fed meeting, of course, later next month, 17th of September. Do you think we're going to get a cut then? And if so, will it be 25, 50, or are we going to walk away empty-handed one more time?
Yeah, I think that 25 is probably what everyone is kind of said is already kind of very much baked in. It would be kind of hard-pressed not to see that happen. Even if the inflation data does seem to be spiking up, I think they could still agree to look through that. If we have very, very weak kind of data on employment, I still think that it's, again, caveat for them to kind of wait another a little bit longer and then do another 25 rather than do 50 in one go.
Yeah, and just before you wrap things up on the Feds, what's your view on growth in the US at the moment? When you look at the US economy, does that appear to you like an economy that's in need of support through easier monetary conditions?
Currently, it doesn't seem like it. I mean, it feels like, which is why the stock market is up. It doesn't feel like we're heading towards any much a hard landing. But what is kind of maybe more clearer from maybe kind of look through to the employment data and certain segments of the economy which may need support. But again, that is something that, with one interest rate policy, the Fed can't accommodate everything. So again, there may be other policies that can be utilized to affect the employment in certain segments of the economy.
All right, Chow of Robeco is going to stay with us. Welcome back. You're watching Insight. Bank of Japan Governor Kazuo Ueda is expecting a tight labour market to continue putting upward pressure on wages. Speaking at Jackson Hole, Ueda also noted that wage growth is spreading from large enterprises to small and medium-sized businesses. Although Ueda did not directly address monetary policy in his presentation, his comments are likely to fuel growing market speculation about another rate hike from the BOJ this year. Well, Chow, head of fixed income Asia at Robeco, is still with us. And Tuha, it's going to be a busy week in mid-September because we'll have the Fed and the BOJ in the same week. I mean, as we expect the Fed to tighten, to ease, is the BOJ going to tighten?
Well, yes, it seems like a lot of, speculations kind of been helped again by Jackson Hole. I mean, the data has been kind of validating, the wage inflation. We've also had the uncertainty of the tariffs with the U.S. Kind of behind us. And then we have had, the growth has not been as weak as feared. So I think all of these gives a lot of room for, at least a 25 basis point hike.
Yeah, you mentioned before the break that you expect to see further weakness in the US dollar. Is a key beneficiary of that likely to be the Japanese yen? Because at the moment, still pretty weak, 147.37 right now. Is the only way up for the yen?
I think it could help the yen a bit if the central banks, the BOJ, starts to act a little bit, and actually maybe as we start to see a bit more kind of interest in the Japanese stock market, I think that would also kind of be very beneficial for the yen. And also, I think political pressure certainly would also warrant that actually a little bit of a strengthening in the yen isn't going to be something that that would be kind of against what the politicians will want. So I think all these reasons may give us a reason for the yen to benefit a little bit in this cycle up.
And what's your view of inflation in Japan at the moment? It's still running pretty hot. Has the BOJ got this under control?
I think some of it is actually imported from the weaker yen that they can definitely help a little bit with. And the other, on the wage side of things, that is a bit more difficult. It is a very tight labour market. They've had to allow more foreign kind of immigrated workers to help with that. And again, policies such as more women in the workforce is kind of dealing with that underlying tightness, but that isn't going to happen very quickly. So therefore, yes, I think hikes would definitely be warranted at this point.
We've seen some very weak demand recently as well for JGBs pretty much across the curve. It appears there's not a lot of buyers willing to step up to fill the void left by the BOJ. So what are the risks going forward here? How do you see these forces playing out in Japan's bond market over the next few months?
Yeah, I think definitely the long end still has a bit of danger to them, particularly with still the steepening as being a real issue there. And I think, again, with inflation, we're talking about, still very negative real yields. So that doesn't make it an attractive bond market. I think the currency may benefit from, say, maybe more from the stock market. But for the bond market, certainly it is, at least at this moment, still not appealing yet until we get much more concrete kind of action from the BOJ that it is actually normalizing the curve and allowing pricing to, be market orientated, and then therefore, which may be a lot higher levels than it is, the yield levels than it is now.
Well, I want to get your views on some of Asia's other major economies as well. And, this week out of India, we'll have second quarter GDP numbers. We're expecting to see a sharp slowdown there, but still 6.6%. I mean, that's growth at a healthy clip. But as you see GDP starting to come down, does that hold any concerns for you? I mean, there's obviously a tariff impact here, but at the same time, a very large domestic economy as well.
Yeah, so the tariff impact, and I think we don't think it's actually going to be very impactful. I think U.S. exports is only about 2.2% of the Indian economy. So, and then things that really matters in terms of exports, in terms of things like electronics, pharmaceutical are currently, exempted. So the impact from the tariffs on the Indian economy is less of an issue. However, the domestic economy is slowing, and therefore there are some supply side policies that it will look like India is trying to kind of bolster that a bit. Some clarity in the GST. Liquidity is being kind of put into the and the RBI have been kind of front-running some of this weakness by cutting. So I think all of this kind of does leave us a bit more constructive on actually what's going on with India. And kind of a case in point is S&P decided to upgrade India on the back of these very kind of big headline tariffs against India from the US, all validating that the structural story is very much intact.
Yeah, do you feel the RBI needs to be delivering any more support, or has it done enough for now? Can it sit on the sidelines for a while?
I think it can sit in the sideline. I mean, there's still definitely room for another 25 basis points in October if they so wish. But I think they can kind of wait and see some of these more supply, kind of these demand side policies that they're putting in with extra liquidity would actually help to bolster the economy without them having to use monetary policy.
Well, we've seen sentiment on Indian treasuries flipping. They used to be very hot property. Now we've got the yields rising. When do you see this sell-off in Indian bonds ending?
Yeah, I mean, I think they, I think it had done very well. Like all things, it takes a bit of correction. So I think, certainly with a more dovish kind of Fed and the interest rate differentials and maybe the currency, because INR hasn't done so greatly, kind of stabilizing, this could actually be kind of very helpful for Indian bonds going forward.
And just before we let you go, I want to talk about China as well. Of course, dealing with, pretty deeply embedded deflation problem here. Do you feel the PBOC and the government are doing enough to get on top of this?
I mean, if you focus on actually where the deflation is really happening, because we were looking inside some of the data point in things like hotel, domestic flights, they've actually been okay in terms of real nominal growth. The area that has really been a big drag on the economy has been manufacturing, oversupply. And I think some of these policies where the government is dealing with anti-involution and making sure that these excess supply, and the funding that from the local governments are being kind of dealt with, that hopefully over time that we start to kind of remove some of those excess supply and actually would help deal with the more focused deflationary problem within China.
We've seen the yuan strengthening gradually all throughout this year. Do you see that trend being allowed to continue?
I think probably at these levels they're kind of happy with it. I mean, say the certain thing now depends also on the U.S. leg of it. But I think what's happening here, there is concerted action. There's a lot of concern that has the Chinese stock market gone too far. But I think you have to look at sectors. There are certain sectors that are going to be benefiting from these much more kind of supply side policies that will actually still benefit. And I think on the tech side of things, it has come up quite a lot. But if you look at the supply chain, AI supply chain, China still is very, very, well, Asia in general is actually still very, very critical to the infrastructure and the hardware that we need to kind of move on with the AI kind of revolution that we're seeing.
Yeah, all right. Chow of Robeco, thanks so much for joining us today with your insights. Let's just take a look at how a few key assets are tracking at the moment. Do want to check in on cryptocurrencies. We did see Ether surging for a record. The first time it's hit a record in almost 4 years. So this is, of course, the world's second largest cryptocurrency. So enjoying a bounce in demand. We also saw Bitcoin rallying on Friday. And this is after remarks from Federal Reserve Chair Jay Powell. He did open the door to that interest rate cut in September, as we were discussing those remarks there at Jackson Hole. So we've got Bitcoin now off that record of 124,500, but still higher on those remarks. So the reaction for the crypto market been pretty... Welcome back. You're watching Insight. China is proposing new rules to regulate internet platform pricing, marking a major shift aimed at curbing unfair practices and boosting transparency. The draft also covers platform behaviour, big data use and coordination between regulators, industry groups and tech firms. Let's get to Beijing and our China correspondent Min Min Lo. So Min Min, tell us more about the new rules.
Yes, Paul, these rules are meant to benefit consumers because one of the rules, for example, would prevent these platform companies from charging different prices to different consumers by making use of the data that they get from consumers regarding their ability and willingness to pay, their consumption patterns and habits in the past to price discriminate. And this comes after market regulators back in May also came out with a new set of proposed rules governing the commissions and fees charged by these platform companies to merchants as well. And the goal, I guess, is to protect consumers and smaller, medium and small size enterprises that are using these platforms, given that they are already, of course, seeing profits thinning because of the consumption slowdown. And these smaller companies, they are the main source of new employment at a time when China is seeing unemployment tick up as well. So the government is cracking down on, the big platform companies, preventing them from abusing their positions of power to ensure that the smaller players are able to do well in the economy as well.
We've also seen Chinese stocks extending their bull run, and this is even though we're seeing some signs of weakness in the economy. Are there any concerns about how enduring this rally is going to be?
Yeah, this is pretty interesting. I mean, I was checking this morning, the turnover within the first couple of hours had already topped 1.4 trillion yuan. And we had seen several days now of turnover topping 2 trillion yuan. That's exceeding the level that we have seen around the DeepSeek moment. And we continue to see this rally taking place in China, which, as you said, is quite jarring given the divergence between what's happening in equity markets versus what's happening in the real economy. Because you look at the credit data, the housing data, the activity data, all of that showing signs of slowdown, not to mention the deflationary pressures because producers' price index had been in decline for 34 straight months. CPI was flat last month, and so some traders are concerned that given this deflationary cycle, it's impossible for the rally to gather steam in a sustainable way. So there has been, different opinions so far, according to economists that we have been speaking to. Some, like Morgan Stanley, are saying there's still legs to run. They're saying this rally could last through the summer because a lot of retail investors are still on the sidelines. So far, the rally has been driven by high net worth individuals, cash-rich clients, and hedge funds as well. A lot of the money are rotating into equities because the bond market is not giving a lot of returns given low interest rate environment. And when the retail investors start to participate in a big way, then we could see more upside to that rally. Of course, it's raising concern about whether we will see a bubble busting at some point, and really harking back to what happened in 2015. But at that time, the bubble burst when China, the government, actually tried to rein in leveraged investing. And some traders are saying that this time, because it's such a slow bull, perhaps that's what the government wants, especially if it can create a wealth effect and translate into better consumer spending in the real economy. Maybe the government will not do too much to bust that bubble this time.
All right, Bloomberg's China correspondent Min Lo there. Well, let's get some more on the outlook for China's domestic consumption and how that's all playing out in the markets. Get some insights from Martin Sorrell, founder and executive chairman of S4 Capital. Now, his business focuses on the digital advertising market across more than 30 countries. Martin, thanks so much for joining us today. I just want to pick up on some of those points that Min was making there. So we've got China grappling with a bunch of issues right now: deflation, US tariffs, an uncertain trade environment. Never mind all of that, the market's rallying hard. Do you think that this has got legs, or is there some risk of a correction here?
Not a stock market expert on China, but do I think the Chinese economy has got legs? Certainly I do. I mean, they're not doing too badly. If you're with or you believe the government statistics are still growing at around 5% a year, which we in the UK would give our right arm for. US obviously has been strong, but not as strong as China. China's economy is about $18 trillion in terms of GDP, and the US about 28 trillion. So those two engines actually, despite the stock market issues, despite the real estate problems, despite the SOE borrowing at a local level, not at federal level in China, despite those three problems, the Chinese economy is fighting despite tariffs. The Chinese, to my mind, are already sort of flipping their trade policy. When we were in Beijing just before the American election talking to government officials, it was clear, although they weren't clear at that time whether Trump would be elected in the way that he was, and was going to impose tariffs in the way that he has. Certainly they were talking about the change in Chinese outbound exports and shifting from a US-directed effort to a more fragmented effort around the world. I mean, if you look at those GDP statistics, the US and China account for about 46 trillion out of 106. So there's 60 trillion outside those two markets, which China is very much focused on. That's Latin America, Africa, the Middle East, Europe, and the rest of Asia. So I think the Chinese economy will remain strong. There is that Chinese meme on social media that Trump is making China great again. So the Chinese, I think, have got the bit between their teeth. It's what I call the Huawei strategy. If you remember, Huawei was nixed in the US and the UK. So what did they do? They shifted their approach to looking at those developing markets that I mentioned. The other thing to bear in mind is the E7, in terms of GDP, is bigger than the G7. And you exclude China from the E7 and the US from the G7, the E6 is still bigger than the G6 from a GDP point of view. So what you're seeing is a change in the world order, which America obviously finds difficult to accommodate and accept, particularly on the right side of the political spectrum, and that's what I think we're seeing. So BRICS, Next 11, Global South are becoming relatively more important. America will remain a dominant economy for a number of years, but the Chinese are certainly catching up.
Mm-hmm. Yeah, you mentioned that the Huawei moment, and maybe we're seeing a DeepSeek one as well when it comes to AI, and I want to talk about AI in a moment.
Yes.
But you mentioned the strength of China's economy despite, I want to throw another despite in there, and that's the consumer as well, who's the sentiment somewhat weak, and it's sparking a pretty fierce price war among a number of China's consumer-facing businesses as well. What kind of pressures do you anticipating building up here?
Well, the consumption has always been an issue in relation to the Chinese economy. It's always been an export-driven economy, and consumption versus savings. I mean, you save for the future, you save for health, you save for the family, and that's always been a big issue in a Chinese context. I wouldn't say it's an issue that is a new one. And really, the Chinese economy is export-driven. And I think the basic point for us in the West to understand is they will change their trade flows. You already see it, actually, in the May and June numbers after Liberation Day, after President Trump imposed these tariffs. You're already starting to see Chinese outbound shift. And the Chinese are very, very adept at shifting their supply chain patterns to accommodate changes in policy. Very agile. You know, the Western companies often talk about agility. Chinese companies practice it. It's an art in relation to Chinese companies. And what we're seeing, we have an operation in Shanghai, very successful last year in the ad industry in China. But what we're seeing is a tremendous emphasis and drive on outbound Chinese. I was in Seoul in Korea just a week before last, and same thing there. I mean, you're seeing Korean companies start to look at the world in a different way. I mean, we've gone into a new era. Growth is going to be more difficult to find. Worldwide growth rates are going to be less than 3% rather than above 3%. Inflation is stubborn, you know, despite the chairman of the Fed announcing that rates are likely to fall. The level of rates, because inflation at UK is still, what, 3.8%, US is still 3%, because inflation is still up there, certainly above the level that the banks, the central banks would like to see of around 2%. Despite that, what we're seeing is higher interest rates than we've been used to and higher inflation than we've been used to. In that world, growth is going to be more difficult to come by. And therefore, people are looking at the world in a very different way. And the growth areas will remain the US, Latin America, the Middle East, and APAC. Africa is too volatile. Europe is too slow growth.
Can I talk about another growth area as well, which is more sector-specific? And, you know, I promised we would get to AI. I mean, you're bullish on AI development, but there's questions about how all of this gets monetized, because we've seen a huge amount of investment, not a great deal of return on investment. Where's this heading?
Well, you're starting to see in our industry, we're seeing very significant developments around visualization and copywriting, and that's compressing the time it makes it takes to make ads and the cost of those ads. Secondly, we're seeing very significant growth in personalization of advertising at huge scale driven by AI. We're seeing media planning and buying. We're a $1 trillion industry, $700 billion in digital, $300 billion in traditional. We're seeing media planning and buying becoming fully algorithmic, very similar to the investing industry. You know, you don't choose to distribute an investment portfolio between property, between equity, private equity, crypto, gold, whatever, other than through algorithmic analysis. Same thing applies to us. Fourth area is general efficiency, and the fifth area is the democratization of knowledge. So AI is starting to have a huge effect. But going back to our clients, they are very focused on the geopolitical risks around US-China relations, or lack of them, very focused around what's happening with Russia and Ukraine and Russia's territorial ambitions, very focused on Iran and its proxies in the Middle East. That is causing significant turbulence. You layer tariffs on top of that, a lot of uncertainty. Once we know where the level of tariffs plays out, I think what you're then going to see is, in that world which is growing more slowly, a huge focus on finding where the growth is and a huge focus on efficiency. It's very interesting. Since the tariffs have been imposed, what we've seen is client margins be maintained. I mean, it's early days, but in Q2 and going into Q3, the projections for client margins remain pretty strong. For the S&P 500, where they have been, and the forecast for the margins to actually improve into 26. For that to happen, you have to implement technology at scale. So whilst in our own case, the only big client that we've seen implement AI at huge scale from a marketing point of view would be General Motors, I think what you'll start to see is companies start to implement quite aggressively, because going into 26, in order to maintain growth, and more importantly, growth in margins and profitability, they're going to have to be more efficient in that slower growth world.
Yep. All right, Martin Sorrell of S4 Capital. We'll have to leave it there, but thanks so much for joining us today.
Thank you very much.
Still
indeed.
to come. Nazara Tech CEO Nitish Mittersain is going to be here to discuss the impact on business as India seeks to ban online games that encouraging gambling with real money. This is Bloomberg. Welcome back. You're watching Insights. India has moved forward with legislation to ban online gambling, citing rising instances of addiction, money laundering and financial fraud linked to these apps. Joining us now is Nitish Mittersain, CEO and Joint Managing Director of Nazara Technologies, which holds a stake in the online poker platform PokerBaazi. Nitish, thanks so much for joining us. So what's your plan for this stake in PokerBaazi? What's the plan?
Yes, I think it's been a surprise move last week. Important to understand it in India till now, gambling and gaming has been a state-wise law. And there's a distinction that's been there for games of skill versus games of chance. But last week, the government came up with a nationwide bill that, banned all games for stakes, whether game of skill or game of chance. And I think that puts platforms such as PokerBaazi, or fantasy sports platforms like Dream11 at significant risk. Obviously, all platforms have complied with the law and paused their services at this point of time.
Mm-hmm. So, what are you going to do with your stake in PokerBaazi? Are you going to divest, or do you have something else in mind?
I think it's early days. The teams there are looking at how they can pivot the business and how they can adapt to the new reality. From a Nazara perspective, obviously, we will have to evaluate, the extent of our investment and any potential write-offs or impairments that we may need to ascribe as per the accounting standards.
So you say it's going to take some time. Do you have a time frame in mind? Is it days, weeks, months before you make a decision?
I think it's likely that we will take an early decision, maybe Q2 or Q3 of this year. Nazara usually, follows a very conservative accounting standard, and therefore we will take whatever appropriate conservative outlook for this particular business is. It's important, of course, to understand that we don't have any real money gaming revenues that we consolidate on our business. And therefore, due to this particular ban, no revenues or operational profitability of Nazara gets impacted whatsoever.
As you're speaking there, we're seeing a chart of the impact on the share price. I mean, it's off, getting on for 18% in the past 3 days when this decision was taken. On year, though, is still higher by 10%. What's the message you'd like to communicate to investors?
I think Nazara is India's most diversified gaming platform. With 70% global revenues, very strong core gaming IPs. We've been around for 25 years. We're a profitable cash flow generating company with close to no debt and nearly $100 million of cash on our balance sheet. So I think we are probably, also as India's only listed gaming company, probably best placed to take advantage of this disruption in the industry and carry on with what we do well.
So you were mentioning a moment ago that you're not expecting to see too much of a significant impact on Nazara's bottom line here. But how about in terms of expansion plans? Have the new regulations caused a rethink at all or a change of strategy?
No, I think on the positive side, there was a lot of positive commentary and regulation around esports, in which Nazara is a market leader in India, as well as casual gaming. So I think that will create massive opportunities for Nazara in the next months and years to come. In addition to our existing business strategy, which does not get impacted beyond this stake in Pokerbazi.
There were some concerns expressed by others that this ban's just simply going to drive users to illegal offshore betting operators. Do you have any thoughts on that? Do you feel it's better to keep the business onshore but regulated?
Yes, I think definitely there will be, users will be driven offshore. And I think the government does plan to come down very heavily on these offshore activities. So I'm hopeful that if this ban has been put in place, then the offshore activities will be restricted significantly. Otherwise, it's a lose-lose for all parties concerned.
Do you anticipate any job losses in the industry as a result of the ban on real money online gambling?
Yes, of course. It's important to understand that 80% of India's revenues were coming from skill-based gaming, not gambling, and that obviously is going to result in significant job losses. But I guess that's something that's par for the course at this point of time.
You mentioned a moment ago that the bill also recognises esports as a sport and the opportunities around this. Is this your key focus for growth now, and what else are you looking at?
So Nazara's primary business is core gaming IP, such as Kidopia, Animal Jam, Love Island, etc. Big Brother, now we've launched a Big Brother game globally. So I think that is our core business. We see that plus publishing in India as very large opportunities, in addition to our esports business as key strategic focus areas going forward.
So Nazara, though, and India more broadly, while this industry is growing, still do lag behind some of the giants such as Tencent when it comes to producing world-class mobile games. What are you doing to? Do you see you potentially joining their ranks one day?
Of course, we will surely do that in the next few years to come. India's gaming industry is obviously a little late to the party, but it's important to understand that this is going to be the fastest growing gaming industry for the next decade to come globally. And it's going to be a very exciting space. We already have 500 million gamers, most of them on mobile. And India already tops the charts when it comes to number of games downloaded every year. However, monetization has lagged, and as the propensity to pay for games increases, I think India will be right on top there, and companies like Nazara should emerge as global leaders.
How competitive is the market in India at the moment? It is obviously a huge market. It's a growing market as well. Is there space for more competition, or is competition fierce at the moment? And what are you doing to stay ahead of your competitors?
I think a lot of the competition was skewed and focused towards the real money gaming space, which has taken a big setback. So I think the path right now for Nazara is very clear. Like I mentioned earlier, we are India's only listed gaming company with significant credibility. And I think we can bring a lot of global partners and partnerships into India to grow this business together.
All right, Nitish Mittersain, CEO and joint MD at Nazara Technologies, which, of course, has felt some impact after the Indian government passed that bill banning the promotion and operation of online money gaming apps. The plan to deal with its stake in PokerBazaar still in the works, an intention to take a look at that in the coming quarters. Let's take a look at Indian markets, how they're tracking at the moment. We have seen, of course, as you'd expect, Nazara Technologies taking a little bit of a hit. As the result of that, it's an understatement, down about 18% in 3 days over the course of the year, though doing okay. And it's a reasonably risk-positive day in India today as well. We've got the Sensex and indeed all of the major indexes up by about 0.25%, mirroring what was seen across much of the Asia-Pacific today. There's, of course, a risk-on tone out there after we received some reasonably dovish comments from Fed Chair Jay Powell at the conclusion of the Jackson Hole retreat in Wyoming. We're looking ahead now to the next Fed decision mid-September, and the consensus is we're going to see 25 basis points of easing. Positive day for Indian markets. See some of the stocks there that are moving. Also tracking some changes in the Nifty index as well. Into Globe Aviation, Max Healthcare. They're set to join the benchmark at the end of the month as part of the semi-annual review. The additions reflecting shifts in demographics and rising consumption. Indus Bank and Hero Motor Corp going to be leaving the index to make room for those newcomers. Before we go, here's a preview of tomorrow's show. Javelin Wealth Management partner Polka Mishra going to be joining us live for market analysis, and that's as traders await key tech earnings and rate decisions coming up this week. That is it, though, for Insights. Horizons Middle East and Africa are up next. This is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 a.m. Hong Kong time. Only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Amory Hordern at the G7 in Alberta, Canada. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power, twice daily, only on Bloomberg.
I want to spend a little bit of time talking about your relationship with autonomous vehicles. It's been it's up and down for Uber over the years, even preceding your tenure. You have stakes in a lot of AV companies.
Yes.
You talked recently about wanting to monetize some of those. What's the strategy?
So we want to essentially support the AV ecosystem and continue to help that ecosystem develop, and then AVs penetrate into the marketplace. AV, we think, represents a safer way of transportation. Ultimately, we think it'll expand the marketplace as it makes kind of safe transportation in cities available to everybody. So we're big fans of AV. And generally, we're working with multiple partners in the ecosystem. Waymo, for example, in Austin and Atlanta coming up. Wave, Avri, there are probably 18 partnerships that we have in the AV ecosystem. And we want to help these players develop by investing in them in some cases, but really by working with them to bring their product to market. These are technologies that are unbelievably promising, but they've taken billions of dollars to develop and 10 plus years. And it's one of those overnight successes that's kind of taken 20 years of development, but is finally ready to hit market, and we want to help the ecosystem get there.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started